Welcome to this Intro to Capital Modelling with Python lecture. I'm Dan Gelderd. This is the first in a series of lectures I'm going to do on dependencies modelling, and in this lecture we're going to focus on the difference between flat and hierarchical correlation structures and how you might achieve them in Python. This video is aimed at junior actuaries on the capital modelling side, GI capital modelling, who are learning more about different correlation structures that can be applied for insurance risk modelling, or for anybody who's got an interest in Python for actuarial work. So if we look at what we mean by a flat correlation approach, this is generally where a single structure is being applied across all granular elements directly in order to create a correlation between them before adding them up into a total. So here we've got 6 classes, and before we aggregate them we want to apply a sort of 6x6 correlation matrix, maybe using something like a Gaussian copula or a student's T copula to achieve all of these mutual correlations at once. You can see here that we've got 15 parameters that we need to pick to populate this matrix. We don't need to populate the leading diagonal of 1s, and we don't symmetrical, so we only need to populate the lower half, but that still leaves us 15 parameters we need to pick here. And in this example, we've supposed that perhaps the first 3 classes are reasonably highly correlated with each other, quite closely related lines of business, and similarly the last 3 classes have got some reasonably material correlation between them. But then for the interactions between the first group and the second group, there's perhaps a weaker cohort of correlations that we're just putting in as a sort of blanket 20% across the board. And that slightly motivates this idea of having a slightly more hierarchical or tiered approach to correlation modelling. So here we're going to, instead of aggregating all 6 classes directly up into the total, we're first going to aggregate 1, 2, and 3 up into a division 1 subtotal, and 4, 5, and 6 are going to aggregate up to division 2. And this changes which correlations we're going to apply, because now we only need to apply a 3x3 correlation matrix to classes 1, 2, and 3. We'll apply another 1, 2, 4, 5, and 6, but now we need a new correlation. We need some correlation that's going to apply to those total level, the total at division 1 and total at division 2. So we need this new third correlation matrix now. And this gives us 7 parameters we need to pick. Let's have a look at how this looks if we move across to Jupyter Notebook and look at the capital package modeling these, and we'll start with the flat structure example. So we're going to start by importing everything from the capital package and setting up some simple settings in the config layer, such as the sim count we're going to be using. And we're going to set some default stats to calculate whenever we call the stats function. And we're going to define some dimensions. We're going to define a class dimension and division dimension just to ensure that any data we import from the various sources are going to have the right class names and dimension names. Then we can get on with the modeling. The first step is to import some data for we're going to set up some loss distributions using some premiums and some loss ratio parameters. So we're going to import both of those from CSV file into our variable objects. And then we're going to simulate some loss ratios by calling the simulate values function from the capital package. And we're going to specify that these should have a log normal distribution, and we're passing in that variable that has all the loss ratio parameters into the parameters argument of that function. And then finally, once we get back the loss ratios, which will be a variable, we can multiply the premium variable and the loss ratios variable to get some losses, which we can view here. So here we see a little summary of the losses that have been simulated. So we've got our 15 classes, and you can see a summary of the statistics, or a snapshot of the statistics, the simulations that have been generated for that. Then we want to import the correlation assumptions. So again, we're just going to import from CSV a variable of all the correlation assumptions we want to apply. And here we have the classes. They're not organized into the divisions, but we have got some sort of specialty lines that are correlated with other specialty lines with a kind of 40% correlation. We've got a higher correlation between two liability lines. We've got a general 20% correlation then happening between classes that aren't in the same division. So similar to the example we were seeing on the presentation. And then we want to apply these correlations. So we're going to call out to the apply element correlation function. We want to apply it to the losses variable. We're going to use a Gaussian copula, and we want to use the above class correlations as the parameters here. We're not going to try and approximate to a nearest positive semi-definite matrix, so we're relying on the input already being PSD. And then as soon as we apply the correlations, we're going to want to measure the output correlations. So we're going to calculate the element correlation stats using this function from the capital package applied to the losses, and we'll see what we get. So here we can see we have output correlations now that are similar to, but not exactly the same as the input correlations. So we've got a little bit of sim error, but we're achieving more or less the kind of 60% on the liability lines, the 40% on the specialty lines, and then lots of 20% for the classes that aren't in the same division. But we want to have a look at the impact that this has on the divisional totals, and we want to look at what this does to the total loss distribution. So we're going to import this mapping from classes to division, again from CSV. So this is just a many-to-one mapping from the classes into the three different divisions. And we want to now apply this mapping, add this mapping to our losses as an extra dimension. And if we have a look at the losses then, we can see we have very much the same data as before, the classes, but now with this extra division dimension just to record that extra data. And again, we can see the simulations for each. We should compare this though to the simulations we had before. So if we go back up to the top, we can see when we were first looking at these simulations, for aerospace we had this 53.2, and then 22.5, and then for auto liability we had 73.8 and 108.5. And if we come back down and look at these numbers now, the 53.2, the 22.5, they're the same. But for auto liability, these numbers are not the same. And that's the effect of this apply correlation function. It's reordered the simulations that have already been generated. It's now reordering them across these columns so that they line up against each other in the way that's going to achieve our desired Gaussian copula. So the first class hasn't moved because that's essentially the anchor, but then all the other classes will have been reordered to match the so that their values align with the first class in the desired way, or relative to each other in the desired way. Now that we've got the division dimension added to our losses, we can easily sum up into the division totals. So we can apply the sum function to our losses variable and say that it's the division dimension we want to sum into. We want to retain that. So now we just get the three divisions and their total simulations. And now we want to run the same stats, the correlation stats function, but now on this losses by division to see what we achieve. And we can see here that we get a correlation, a non-zero correlation between the three divisions, and they're all roughly around 30%. So not numerically the same as that 20% we were putting in for the between class correlations. There's a kind of apparent strengthening as you measure the correlation between these aggregated divisions, which is worth noting. And then finally we can look at the total losses. So we're going to aggregate up one step further just by summing the losses by division, and then we can calculate the stats on the aggregate loss distribution, which will apply our default stats calculations, and we can get a nice summary of the aggregate loss distribution. Now let's run through the same type of modelling, but we're going to take the hierarchical or the tiered correlation approach instead, using the divisions to define the correlation as we aggregate up. So again, we're going to import from the capital package, and we set up the same dimensions. We're going to bring in the same premiums and loss ratios data and simulate the same losses. We're going to bring in the same class correlations. I can bring in exactly the same class correlations matrix as before. But now we're going to bring in the class division mapping a little bit earlier. So this mapping to the divisions is brought in so that we can add that dimension to the classes at an earlier step. And now we've got our losses before we've done any reordering with this division intact. And this is going to allow us to iterate over the divisions and apply the correlation just to the classes within each division. So to do this, we're just setting up a simple Python loop. We're iterating through the divisions. We're using this dim function on the losses variable and specifying that it's the division dimension we're asking about. So this is going to create an iterable for us with all the different divisions that exist within losses. So this is now going to iterate over the three divisions, property, specialty, casualty. And we're going to apply the element correlation just as before, but now the variable we're going to apply it to is going to be the losses filtered for the division being this division from our iterator. So now we're just filtering down to the subset of the classes within the division and applying the copula, and we're applying the above class correlations. And this function is quite convenient because I don't have to chop the matrix down into three separate matrices. It's just going to read from the matrix input the correlations for the relevant classes in each iteration. So I can use the same data in each of the three, but it'll just apply it to the three different subsets of classes one at a time. And then we're going to, again, measure the stats. I'm summing back into the class dimension at this stage just to remove any noise in the stats that we see. And we see here we've got the same kind of correlations as we were getting before. Within specialty, we're getting that kind of 40%. Within the liability lines, we're seeing the 60%. But at the moment, we're getting kind of 0 between the but for the classes that aren't in the same division, because we haven't yet imposed any correlation that relates them. We've only imposed correlations that apply within each of the divisions. We can see this maybe a little bit more clearly actually if we take out this sum and we just have a look at the losses, the stats on the losses while that dimension, that division dimension is still intact. So if we regenerate that, we can see that now we've got this kind of specialty to specialty. So within specialty, we're seeing the sort of the 0.4s exist. Within casualty, we're seeing the 0.6s exist. But crucially, we're seeing no kind of correlation across the different divisions. Now we're going to sum up, though, into the division again, get our division totals, bring in a new correlation input. So this is this additional correlation assumption that we now need to make because we're going to apply correlations between the divisions. We need to say what that correlation strength is. So we're going to bring in correlation assumptions to apply directly to the divisions, and we're using that 30% that we saw was roughly the same as what we were achieving when we did the class-to-class correlation before. So we're going to apply that to the we're going to apply it now to the variable losses by division, again using Gaussian, and we're going to measure the achieved stats, and we can see that we are achieving something close to the 30% between the different divisions. And now we're going to want to look at the achieved correlation between the classes. So if we go back and look at the losses again, and look at the correlation that's achieved on the losses, this isn't the losses by division, but just the original losses by class, we see what we've achieved between these classes. So again, that 40% between specialties is still intact, that 60% between liabilities still intact, but now we are achieving some non-zero correlation between the classes that aren't in the same division and close to that kind of 20% that we were seeing when we set up the first example. So it's kind of worked in reverse now and given us something similar to that 20% that we were first putting in. So this is really interesting that it's done this. This is because the capital package is doing quite a lot of work for us there, as those divisional totals are being reordered with respect to each other to achieve the 30% correlation at the total division level. It's keeping track of which classes belong to each division, and it is reordering those underlying class simulations for us, so that now when we measure correlations at the class level, we can see that they've inherited some of the divisional correlation that's been applied. And we can measure the final stats by applying this stats function to our aggregate losses, and we come up with a distribution here which is not dissimilar to the distribution we modelled the first time round. Now that we've discussed what we mean by a flat and a tiered correlation structure, and we've seen how we might go about modelling these, let's quickly talk about why you might choose one over the other. The main pros of having this flat hierarchical structure are that it's very simple conceptually and in terms of its implementation. And probably the main reason you see people use it is because it gives very fine control over any pairwise correlation between any two of the granular elements. But there are some cons to this. So there are probably a lot of pairs that you don't really care about. You're also restricted to just using one type of copula across the top. I can select a Gaussian or a student's T, but I can't mix different copula selections for different cohorts of classes, and I can't pick different degrees of freedom on the student's T copula. It's one copula across the whole lot. It can be a challenge when you're dealing with the large matrix, and these matrices can become pretty large if you've got a lot of classes in your model. There's a challenge to maintaining a set of assumptions that are coherent as far as a correlation matrix goes. In particular, these got to be positive semi-definite. And this is made more complex as the model structure changes over time. So if you imagine adding a new class to your model, that creates a new row and column in that already large matrix. And now we've got to pick all of those parameters for all the pairwise correlations against all the existing classes. And we've changed that whole matrix has now been changed. And we've got to hope that that new row column that we've added retains the positive semi-definiteness of the original matrix. It doesn't distort anything we were already doing. So there's a little bit of a challenge there maintaining it over time. When we think about the tiered approach, the pros are it's still a pretty simple approach. We saw the implementation in Python. It wasn't much harder. And it does greatly reduce the number of parameters. We saw when we were just dealing with 6 classes, it was the difference between 15 assumptions we had to pick when we were doing class-based modeling, and if we split it into 2 divisions, that goes down to 7. So we're kind of halving the number of parameters to pick there. That's even more dramatic as the number of classes increases. It allows a mixture of copula types. So as we were correlating the classes in Division 1, we could have used a student's T, and as we were correlating the classes in Division 2, we could have used a Gaussian. And you can pick different copula structures, again, for the division-to-division correlations. So you've got a little more flexibility as you aggregate through the structure in picking different shapes of correlation. And I think one of the crucial advantages of the tiered approach that I don't hear discussed often, but I often advocate for, is that it forces you to think about different drivers of risk as you're coming up with the parameterization of the model. If you think about what your workflow is as you're coming up with your assumptions in the flat correlation structure, all you're talking about is individual class to individual class type correlations. So these are very much thinking about the idiosyncratic risks that each class faces and what might make one particular class go bad at the same time of another. But these can be quite kind of small, like I say, idiosyncratic sort of risks, maybe affecting just a couple of classes. Whereas if you start thinking about a whole division going bad at the same time as a whole other division, what are the kind of drivers that cause all of your property book to go bad at the same time as all of your specialty book? And these are perhaps much more likely to be the kind of macro exogenous shocks and major drivers. Um, and I think it forces you to make sure you're considering both the sort of the lower level risks and the sort of more idiosyncratic risks, as well as uh, the the larger sort of macro risks as you're thinking about that correlation parameterization approach. Cons of the tiered approach is that you lose some control. So thinking back to the main advantage of the flat approach is that retention of control. If I was particularly interested for some reason in controlling the correlation between class 1 and class 4, I would find that I don't have that ability. I can control the correlation between division 1 and division 2, but how the class 1 to class 4 correlation gets, inherits from that is not directly being controlled by me. So if that was an important subtotal that I wanted to keep control of, then having them split into different divisions might not be an optimal structure for me. And we're going to finish with a little bit of numerical sensitivity testing outputs just to see if there are any other advantages or other things to consider on a practical basis between these different methods. So we're going to run 2 different runs where the only thing we're going to vary is the strength of the between division correlations. So setting up a slightly different example where we've got 15 classes and another one where we've got 150 classes, and these are being split into different divisions. Within the divisions, we're keeping a constant 50% correlation. The only thing we're going to change is the strength of correlation between the divisions as we go in the first run compared to the second run. So when we're doing the flat correlation approach, we have this kind of block of pairwise correlations that we're specifying between the divisions, and we're initially going to set that to 15%, and we're going to look at what the impact is on the results as we increase that to 20%. When we're doing the tiered modeling, the between division correlations are explicitly entered through that division total to division total extra correlation matrix, and we're going to measure the impact as we go from a 25% assumption up to a 35% assumption. And we're going to look at that for runs where we have 15 classes split into 3 divisions, and when we've got 150 classes split into 15 divisions. And we're just going to examine what the sensitivity is to both sim error and to some of the empirical results as we vary that correlation parameter and the class count. So excuse the slight change of layout. We've now got the 15 class 3 division results here on the left and the 150 class 15 division results on the right. And those 2 runs that we were discussing are being listed as 2 rows in each of these mini tables. So in the flat method, in run 1, we're controlling the 15% correlation. This is the input correlation between classes, but going across divisions. So in run 1, we have the 15% assumption going up to the 20% assumption. And we're looking at what we are getting out as results. We're looking at 2 results. We're looking at the achieved correlation between the divisions. So if we remember looking at the Python example, we saw that we were actually achieving numerically a bit of a higher number when you measure the achieved correlation between the divisional totals. So we're looking at what that achieved correlation is, averaged across all the divisional pairs. And the other metric we're looking at is the stress, that deviation between mean and the 1 in 200, the 99.5th percentile of the aggregate loss distribution. So we can see in this first run, our input correlation strength going from 15 to 20, so that's a sort of 33% increase in that assumption. And we're achieving a broadly proportional increase in the achieved strength of the correlation between the divisions. We're seeing a 5% increase in the modeled stress. Now, if we compare that to what happens when we're running on many more classes, do these relationships change at all as we suddenly have a much larger model with 150 classes and 15 divisions? So we're doing exactly the same input change. So the correlation that we're imposing between classes that are in different divisions is still just increasing from 15 to 20%. But if we look, we're actually getting very similar achieved correlations between the divisions. Empirically, still kind of very similar kind of levels. So that 26% compared to 24 in the 15 class example, 35 compared to 31. What is different though is the impact that we're seeing on the stress, the final aggregate results. This is a reasonably material number. So what we're saying here is that if we were to increase this one assumption, um, admittedly it's one assumption that's appearing many times in the model because it's in all of the sort of off diagonal class to class pairings that aren't in the same division. So there's potentially quite a lot of instances of this in that large matrix. But this isn't a huge change in an assumption that is pretty uncertain. It's very hard to estimate empirically what these correlation strengths should be. These are very judgmental numbers, and I think most people would agree that that kind of 5% is within the range of what we would be able to assert is a legitimate range for this parameter. And this isn't to say that this is an exhaustive range. Should that really be 10%? Should it be 25%? There's certainly a range of plausible parameters here, but with just this relatively modest change in this parameter, we're seeing a 16% change in this aggregate risk profile stress. So these parameters, even though they're perhaps the sort of slightly unloved default parameters that just get put in sometimes to fill out these large matrices, just important to note how significant they can be to the final results, and much more important than we saw in that 515 class example. And this probably is no surprise, as our model has now many more individual pieces. The assumptions that relate to the correlation between those pieces suddenly become so much more material, and this is genuinely a very material assumption in the context of this little model that we've got here. Now, is any of this changed as we go from the flat modelling approach into the hierarchical or tiered modelling approach? And based on the sort of limited tests I've done here, empirically there's not really much evidence that it does, which is quite interesting in itself. So we're putting in now the input correlations that we're controlling are the ones between the divisions. We're choosing to go from a 25% assumption, and we're going to run it again, but with a 35% assumption. And these are deliberately picked to kind of match what the achieved correlations were from the flat test. And the first output we're going to measure is what's the achieved correlation between pairs of classes that are in different divisions. So kind of working in reverse. And we can see here that the 25% input is yielding an achieved 14% output, which is not dissimilar to the 15 here. And the 35% input is achieving a 20% output, which is sort of not dissimilar here. So really there seems to be quite a lot of stability between this relationship, and it's holding true as we look at the 150 class example as well. So the 25 input is achieving something like a 15%, which is consistent with before, and 35% assumption is achieving something like a 18%, nearly 20 that we were seeing before. So this sort of stability presents some kind of stability here, potentially in the relationship between the division to division totals and the class division to division correlations and the class to class correlations across divisions. And that may yield alternative approaches to parameterizing or validating some of these assumptions, because it suggests that you could come up with the parameters considering one level of granularity, but then maybe validate the achieved correlations against some judgmental assumptions at the alternative level of granularity. So potentially a route there that you could explore. But do we achieve any improvement in the stability of the model in terms of reduced sensitivity to this judgmental parameter? Well, it's very similar. We're seeing a slightly higher impact on the stress here, but we are putting through a 40% stress on the the input correlation, which is maybe a little bit higher, but doesn't appear to be any significant difference really in the sensitivity of results to this parameter. So whether you're picking one blanket parameter and applying it to lots of class-to-class um, correlations across the divisions, or you're just picking the division-to-division correlation directly, similar kind of sensitivity of the final aggregate distribution to those. So this is not suggesting that there's, particularly, an empirical reason advantage of one over the other in terms of stability. The other thing I've considered is simulation error. So we've done 10 runs and looked at the stability of this number, so the stress number. And of those 10 runs, there's a range of the highest to the lowest achieved output from the different kind of runs, the different seeds, and the standard deviation across those 10 runs. And we see here, as we compare the flat to the tiered, empirically not very different, similar kind of range, similar kind of standard deviation. And similarly on the larger model, as we compare, similar kind of standard deviation across those 10 runs, similar kind of range. So again, in terms of stability from simulation error, or as we were discussing before, stability in terms of sensitivity to changes in the assumption, empirically this doesn't appear to be much differentiating the two approaches. So I would say when you're deciding on which one to adopt, I would go back to more of the operational considerations that we were talking about before. Thank you very much. If you have any questions or comments, I'd love to hear them. Please comment below or contact me on LinkedIn. Thank you very much.